The number one question I constantly receive from stock traders is, how do I become successful trading stocks? This is an excellent question since I believe it shows the person is willing and ready to better themselves as a stock trader. Before moving ahead, welcome to the Stock Monster, the largest YouTube channel where money minds rethink rich. Please take a moment to hit the like button, and if you have not subscribed to our channel yet, go ahead and subscribe to Stock Monster to stay connected. When money is on the line, our emotional attachment to it can take over our decision-making process. Thus, it would be helpful to examine some of the most common trading problems resulting from mental breakdowns. Hopefully, these solutions will help you correct common trading mistakes by looking at the emotional conduits to decision-making. Problem number 1. No patience on entry. Expecting a signal that never comes is common for traders observing the market closely. For example, a great buying opportunity emerges when a stock breaks from a rising triangle. Bouncing in ahead of the breakout isn't a perfect situation. The probability of success in buying an increasing triangle isn't as great as avoiding one. What causes this mistake? Fear of losing out on the tremendous number of benefits is one. Fear of risking too much money in buying a stock is another. The straightforward solution is to wait for the entry signal, but you can do a few things to help yourself remain restrained. Rather than watch potentially good stocks tick by tick, utilize a caution feature to alarm you when they make a break. Observing stocks is, to some degree, hypnotic. It is almost as if the charts can talk you into making an exchange. Another great solution is to focus on diverse contemplations when considering a stock. Do not think about potential benefits or minimizing losses. Instead, focus on the craving to execute high-probability trades. It takes time to reconstruct yourself, so strive forward. Problem number 2. Selling too soon. Traders have all felt the dissatisfaction of not selling a stock at its peak. When a stock is rising, there is a point where it is expected to sell to lock in the gain before it goes down. The issue is that after the stock is offered, it proceeds to go higher, clearing traders out with an opportunity missed. There are a few things that can help traders avoid falling into this trap. First, go through past exchanges and apply the same selling rules to see if the stocks have been restrained. Compare those results with what you have accomplished. I did this, which gave me an adequate confirmation that maintaining discipline pays off and is worth working for. When I did this over one specific one-week period, the difference measured to a pretty nice new car. That gave me the use of my emotions I needed to overcome them. Second, turn off the benefit and loss pointer that most brokerages and trading platforms use. How much you're up or down is unimportant to the decision-making process. Since we have an emotional attachment to money, knowing that we're up a certain amount and seeing that recoil on a typical pullback in stock leads us to make reckless decisions. At last, keep in mind to sell at floors, not ceilings. Don't limit the upside movement of a stock by setting a cost target, but instead limit the drawback movement by selecting a floor target. Sell a stock immediately when it pulls back to a base instead of selling it in anticipation of a coming ceiling cost. Before we continue to the next section, it would be truly appreciated if you could drop a like. If you haven't already subscribed, don't forget to join the Stock Monster by hitting the subscribe button. All the support helps this channel out. Problem number 3. Trading low probability opportunities. You cannot make the stock market go your way by hard work. The great Vancouver stock promoter Murray Pezim once said that all abnormal profits in the stock market are just short-term loans. Traders will tend to require low probability exchanging openings at the wrong time because it is during the worst market conditions, which only show a few choices. By working hard, dealers can find an opportunity that is pretty good but not extraordinary. The trader sets themselves up for disappointment by taking these lower probability exchanges since their success rate will not be as great. I have said it numerous times, when the going gets tough, requesting traders gets sluggish. You must continuously be picky about the kind of exchanges you make, especially when the advertising is weak. Working hard to find opportunities will not give you more cash. Teach yourself first to look forward to the slow times. Make a list of things that you are just going to do when the market slows down. Problem number 4. Hesitation. You're observing a stock that has all the right signals you search for in an opportunity. The fantastic point to enter comes, but you wait instead. You second-guess the opportunity and do not purchase the stock. As a result, you get behind while the market pushes the stock higher. A short while after the beginning entry signal, when the stock has made a conventional gain, you decide to enter the trade at last. After all, the market has demonstrated your analysis, so you must be wise and right. That's just a confidence issue. You're not sure about your ability to analyze stocks, and you are not fulfilled with the strategy you're using to pick trades. Therefore, you have got to research your strategy so that you have the confidence that it will work. At that point, you have to start minor, making trades with a potential loss that you are comfortable with. As you gain confidence in your strategy and your capacity, increase the trade estimate. Along with your newfound confidence, stand in a crowded room and shout, "I am awesome!" Well, maybe don't carry it that far. Problem number 5. Letting winners turn into losers. Many of us have probably had a time when the exchange was extremely profitable, and we began to reap the benefits. However, when the stock started to lose the ground it had gained, we avoided selling because we had built up an active connection to the profits we acquired. Rather than selling the stock to lock in a few gains, we decided to wait for the stock to return to its peak, hoping that it would go back to the point where we felt great about trading. Although, when the stock continues to float lower, our gains begin to turn into losses. We eventually sell it at the bottom price, swearing never to do it again. Like Kenny Rogers used to sing, "Do not count your money once you're sitting at the table. There will be time sufficient for counting when the dealing's done." Don't calculate your benefits before you lock them in. Maintaining a strategic distance from trading will help you avoid a passionate attachment to the monetary benefits. In the end, with these tips, there is no doubt that you will become a better and more efficient trader. The difference between those who succeed in trading and those who fail is how well they play and observe the market. Your mind can be a practical thing. Do not let it beat you in the market. That's all for today. Let me know down in the comments if you agree or if you think there's something I've overlooked. If you enjoyed this video, don't forget to drop a like, and don't forget to join the Stock Monster by hitting the subscribe button. Thanks for watching, and until next time, best of luck in the markets.